So any questions with respect to items you're working on, getting ready to submit, et cetera, before we launch into more of a discussion about today's material?
Yes, I have on the ICP on the organic growth, and there on number 2, you asked that given the ROIC we've calculated, what would we do with the firm's non-operating assets, and how would we expect this to affect the firm in the long run? And then we're going to have to make a recommendation and that. So I would like if you could run us through a little bit.
Yeah, in fact, I expected this. In fact, I put this element in this problem set specifically to get students to think about this. So for those of you that haven't reviewed the case or aren't very deep into it yet, one of the things you're going to find in this case, in our story, is that the firm has been told by some outside consultants that if they would redeploy some non-operating assets, and then, which means maybe sell those assets and get the cash from them, they might be then able to reinvest that money in the operation of the company and increase revenue by, I think it was what, 5%? Is that right?
Yeah.
Yeah, right here, right there, 5%. So, so my discussion with respect to number 2 is all about that. Okay, I don't know if it's obvious by my question that that's what it's about, but that's what it's all about. So I want you to think this through for a minute. Here I said, given the ROIC you've calculated, so we got a 14.25% return on invested capital. What do we think about the recommendation that we've been given? Well, it would suggest to us that we first should take a look and see if those non-operating assets are giving us at least a 14.25% return on their capital, right? If they are, then they're giving us at least the average we're getting for the company, or maybe even better, in which case you ought to leave them alone. If they're not, then maybe we should think about liquidating them, and if we liquidated them, what could we do with them? Okay, so let's look at those assets for just a minute. Here I've got the financial statements, and I see that we have 2 other assets, some patents held at 125 and some rental property at 60. And these are their book values. And we know that the book values may not have any direct relationship with their market values, right? We're making the assumption in that case that there's not been any mark-to-market accounting, but I think that's a fairly safe assumption to make at this point. We also see that we have some revenue lines associated with these. So the patents held spin off royalties of 20 each year. And the rental property spins off a net income of 9 in the prior year and of 10 in the most recent year. So that $30, so 20 plus 10, is being spun off of assets valued at 185, or on the balance sheet at 185. And this, we can think of this as being the invested capital, and the royalties and the rent as being the net operating profit less adjusted tax. Or we can morph it into net operating profit less adjusted tax, right? Because we're talking about the net income from rent, so expenses have already been factored in. And you probably realize that when you own a patent on something and collect royalties, there are no real expenses associated anymore. The expense that was associated all went into the creation of the patent, and that's probably at a point in the past. So if we want to think about this in terms of net operating profit less adjusted taxes, we'll just take the $30 in royalty income and rent income, and let's divide that by the invested capital of the patents held in the rental property, or 185. And it tells us, well, we're getting 16.22%. So on the surface of this, that looks like we're getting a higher ROIC with these assets than we are with the company as a whole. Do you follow me so far? Any question? Okay, but here's the question that I'm going to ask. Martin, I'm going to let you come off of mute there so you can answer this. What's the likelihood that those patents and real estate have a greater market value today than the book value?
I have no idea.
Okay, so let's say you purchased a piece of real estate 5 years ago. Would you expect it to have a greater market value today than its book value?
Yeah, probably.
Sure. Okay, so in this case, if we've already assessed this and found that the immediate ROIC that we've identified is greater than the average, now let's find out if that still holds water when we think about the market value of these assets. How would we go about finding the market value of these two assets on our balance sheet? You're oh so talkative. Think about it. How do we know to find a market value or a value? Is it possible to find an asset's value if we know its cash flow?
Yeah.
Yes.
Sure. Okay. Now we know some models we can use for that, right? As it turns out, that when it comes to real estate, commercial real estate is often valued based upon its multiples of operating income, and residential real estate is most often valued on comparables. So we can even think about this in that respect. But I'm just going to kind of think about it with respect to its cash flow. Well, we know it's got some cash flow. We know it has cash flow of 20 plus 10. Maybe we'll adjust that for tax. Okay, maybe we'll turn that into EBIT. And so we had that 30. And if we want to turn it into what something like no plat, we're going to take and multiply it by 1 minus the tax rate. What was our tax rate here?
34.
34. So we're gonna take it times 1, or we're gonna take it times 0.66, right? That's gonna be 1 minus 34%. So it's 19.8 is the cash flow, and this cash flow would be in year 0, so our base year, right? And we might be able to suppose that over time the cash flow grows, right? Now we knew it grew from 9 to 11, or rather 9 to 10 here. It's grown from 29 to 30. So there's some growth rate. Well, do you think you could find the value of an asset if you knew its next expected cash flow and its growth rate, assuming you knew some discount rate? Well, those are the components of the Gordon growth model, if nothing else, right? So now let's go and take a look at the answer. So I've gone ahead and walked through some of this, exactly as I've just said, but the piece of information I have here that we didn't just talk about is we can borrow capital at 7%. So in order to think about the value of those two assets, given their cash flows, we need to think about the growth rate of the cash flows, and we need to think about the discount rate that we would apply to our cash flows. Well, if we can borrow money for 7%, and then I would say that a pretty obvious discount rate we might apply to these assets would be 7%. You might apply to the assets a growth rate that would be equal to whatever growth rate we're observing. And we see that it went from a cash flow of 29 or EBIT of 29 in 2013 to an EBIT of 30, so a change of 1 in 2014. So if I take that 1 and divide it by the 29 to get a percent change, that's a 3.45% change or growth. So I think that if I can calculate the expected cash flow for year 1, so that would be the next year, 2015 in this case, based on these assets alone, and if I could then divide that by the discount rate of 7% minus a growth rate of 3.45%, which is what I just calculated, I can come up with a continuing value or an expected value, a terminal value for those assets, couldn't I? Make sense?
I guess.
Okay. So now that we've walked through thinking about doing that, I could do the same thing by applying those, a more sophisticated way of looking at those. I could even look here at using a free cash flow model in which I have used the KVD form of free cash flow. Or I could use any kind of construction here for the model that I know is a credible construction, as long as I can get the values and variables to fit into it, right? Well, whether we use a Gordon growth or we use this number I've just given here, or the structure I've just given here that effectively uses the KVD formula, I've come up with a value. And in this case, I came up with a value of 688.89. Well, that's a whole lot more than we've got on the balance sheet at 180 combined. So Brandon, I'll ask you a question. Which would you probably choose if you're a business owner? I'm going to let you come off mute so you can answer this. You're a business owner. You're currently getting 16% on an asset you show on your balance sheet at 185, right? I think it was 185, wasn't it? Okay. But we're not really getting 16% because we've said that has a market value of 688. So we knew it was giving us a 30 EBIT. If we take that at 1 minus the tax rate, it was 19.8, right?
Yeah.
And if we take it against the market value of this capital, so we're going to say 19.8, which is our no plat, if you will, or is the tax adjusted EBIT, divided by a market value of our invested capital of 688.89, we're only getting 2.87% on that invested capital when we think about its market value. So if it were you, would you consider selling those two assets that have such a low book value but a nice market value, and then taking that 688 and reinvesting it in the company in such a way to drive additional revenue?
Yes.
I would too.
Yeah.
And Victor, that's what I'm talking about in number 2. Now, I've used some different words. I might even give you a couple of additional ways of thinking about the valuation structure, but that's what I'm looking at.
Yeah.
Okay. Good question. What other questions might you guys have with respect to this problem set?
Me, I have a question for the number 1, actually.
Okay.
Just with the formula, are we going to go through this today, or we can just take about the capital efficiency?
Good question. No. The capital efficiency, well, I will now, Alex, since you asked, okay? The capital efficiency is one that I think you'll find on the corporate finance quick sheet, and it's one that you should have become familiar with in Finance 300. But the capital efficiency rate, or the CAP-E, is simply a revenue from operations divided by invested capital. Okay, that's all it is. And so one way of calculating ROIC is to take the profit margin, and you know the profit margin is net income divided by, net income divided by sales or gross revenue. I'll give you the profit margin. If you take that times the capital efficiency, it's going to give you an ROIC.
Right.
Okay. And that's how I got the 14.25 here. Now you could have gotten ROIC other ways as well. But that's just, I was just introducing a new one to you by introducing this equation to you. Okay. I will admit to you that even though that's an interesting equational form, I rarely use it. In fact, I only use it when I don't have the other inputs to ROIC. I prefer using no plat divided by invested capital, but sometimes we don't have those inputs. And we do have these sometimes. Okay? Is that your only question on this?
Yep.
So here's a question. How does this ROIC compare to ROIC when we take no plat divided by invested capital? Well, let's go down and let's find our no plat. Well, I think we already have it. Right, it's right there. So we've got no plat at 436.26. So I'll just take, what about the calculator, divide that by invested capital of 3059, and we get 14.26. So the two equational forms should give you almost identical answers. And in this case, they do, if not virtually identical. Good question. I like this problem set. I don't know if you've been introduced to Lesch-Cal Industries in any of the other problem sets. I just can't remember. But I like this problem set in part because it makes you think through what I'm introducing to you in item number 2. I think it also causes you to do a forecast with adjustments, does it not? Maybe not. No, maybe not. Okay, any other questions on this?
About number 3, there we were just checking out what the forecast is, and you put there on the answer sheet, you put the Lesch-Cal Industry leadership premium 25% in parentheses, and then you put 1% there.
Yeah.
Why is that?
Because it's a 25% proportional adjustment. So it's going to, 25% would be on top of the 4% industry growth. So a quarter or 25% of 4% is 1%. So if I'm in an industry that is expected to get 4%, and if I'm a leader in that and I've got a 25% proportional leadership premium, and that's how this was discussed in the story, then 25% of 4% is what we're looking at. And that's why I put 1% there. Does that make sense?
Yeah.
I think maybe an even more interesting question is this adjustment down in my, 6th bullet point or so. So let's walk through this and make sure that we understand what I've done here. So I've taken the expected industry growth rate of 4%. I've applied a premium to it. That was 1. I've said, okay, we will go ahead and reposition some of our otherwise lesser productive assets. And I think we will get an extra 5% in revenue by having done that. That's what the consultant said, and I've satisfied my own curiosity having gone through question number 2. And the sum of those together is 15%. Why might I not just apply that 15% growth rate instead of make some adjustment to it?
But it's too high.
Well, what makes it too high, Alex? I agree with you, but why is it too high?
Because the WACC was 12.
Well, WACC and growth in this respect don't have a problematic relationship. Remember, the problematic relationship is WACC and long-term growth, and this would be explicit period growth. So I don't know that that's expressly why. What else might I consider?
Compared to the other in the industry?
Well, maybe compared to the industry, maybe compared to my firm's history, right? Maybe compared to what I think my management team can eke out. I mean, here I am. So Jade, I'll let you think about this. This company's never seen more than about a 12% growth rate in its life. And we're about to tell it that we're going to have 15%. We're going to bank on that. Does that sound like something a banker would want to bank on?
No.
No.
Well, and I think specifically just between the 2 assumed 5%, that those might be reality, but those are they're reasonable assumptions, but they're still relatively optimistic assumptions.
Yeah, they're assumptions. And so what I'm saying here is if that all adds up, and I skipped over the bullet point that said distribution of other products and services, but that's part of our upcoming plan for this company. We hope it'll give us an extra 5% in revenues. We hope repositioning the assets will give us another 5% still, but hope can be audacious at times. And so sometimes you just have to put it through a gut check and see if it just makes sense to you, if you think you can pull it off. And so that's what I've done here. Now, did I have to? No, I could have just used the 15%. I chose to, because, and what that's telling me as a manager, that I don't necessarily believe that my projections are as conservative as they ought to be. Here is one of the great lies. And in fact, I think that there are three kinds of lies when it comes to forecasts. There are lies, there are damned lies, and there are management's expectation of revenue growth. I think that's the third lie. And it trumps a damned lie, okay? So I think it behooves us to try to make these a little more reasonable. And so to recognize that they were only a wag to begin with. Okay?
But excuse me, what does WAG mean?
Wild ass guess.
Okay.
Okay, it's a technical term.